Smart Money Moves, a beginner's guide to investing and building wealth. Investing might seem like a complex world reserved for finance professionals, but it is a powerful tool that anyone can use to build wealth over time. Whether you're planning for retirement, saving for a major purchase, or simply looking to grow your financial foundation, understanding the basics of investing is essential. This guide is designed to walk you through the core concepts, strategies, and practical steps needed to start investing with confidence. Understanding the basics of investing. At its core, investing means putting your money to work by purchasing assets that have the potential to increase in value. Unlike saving, where funds sit in a bank account with minimal growth, investing aims to generate returns through the power of compounding and market appreciation. Key reasons to invest. Beat inflation. Inflation gradually reduces the purchasing power of your money. By investing, you aim to achieve returns that outpace inflation. Build long-term wealth. Even modest returns, when compounded over decades, can significantly boost your net worth. Achieve financial goals. Investments can help you reach specific financial objectives, whether it's buying a home, funding education, or preparing for retirement. Generate passive income. Certain investments, such as dividend-paying stocks or rental properties, provide income streams with little ongoing effort. Understanding these foundational benefits can help motivate you to take that first step into the investment world. Exploring different investment options. The investment landscape offers a variety of asset classes, each with its own risk profile and potential for returns. Here's an overview of the primary investment options available to beginners. 1. Stocks. Stocks represent ownership in a company. When you purchase a share, you're buying a piece of that company, and your investment can grow as the company's value increases. Pros: high growth potential, dividend income, liquidity, as stocks are generally easy to buy and sell. Cons: high volatility and market fluctuations, potential for significant losses if the company underperforms. 2. Bonds. Bonds are fixed income securities where you lend money to governments or corporations in exchange for periodic interest payments and the return of the principal upon maturity. Pros: more stable returns compared to stocks, lower overall risk, regular income through interest payments. Cons: lower growth potential, sensitivity to changes in interest rates and inflation. 3. Mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, allow investors to pool their money to buy a diversified portfolio of stocks, bonds, or other securities. They offer an accessible way to achieve diversification without needing to pick individual stocks. Pros: instant diversification, professional management, convenience in investing in broad market sectors. Cons: management fees can eat into returns, may not outperform the market if actively managed. 4. Real estate. Investing in property, whether through direct ownership or via real estate investment trusts, REITs, provides opportunities for both capital appreciation and rental income. Pros: tangible asset with long-term value, potential for steady cash flow through rentals, tax advantages, including deductions and depreciation benefits. Cons: requires significant capital and maintenance efforts. Market cycles can affect property values, less liquidity compared to stocks and bonds. 5. Alternative investments. This category includes assets such as commodities, gold, silver, cryptocurrencies, and collectibles. They can provide additional diversification and sometimes serve as a hedge against inflation. Pros: diversification beyond traditional assets, potential for high returns in emerging markets. Cons: often highly volatile. Regulatory uncertainties, especially with cryptocurrencies. Typically less liquidity and more speculative in nature. Developing a winning investment strategy. Before diving into the world of investments, it's critical to develop a strategy that aligns with your personal financial goals and risk tolerance. Here are some key principles to guide your planning. Define your financial goals. Begin by clearly outlining what you want to achieve with your investments. Are you saving for retirement? a new home, or building an emergency fund. Defining your goals will help determine your time horizon and the level of risk you should be willing to take. Assess your risk tolerance. Risk tolerance is a measure of how much fluctuation in investment returns you can comfortably withstand. If you're uneasy about the possibility of losing money, you may favor more conservative investments like bonds or diversified funds. Conversely, if you can handle higher volatility, you might allocate more funds to stocks or alternative assets. Embrace diversification. One of the golden rules of investing is diversification. By spreading your money across different asset classes and sectors, you reduce the risk of a significant loss from any single investment. A balanced portfolio might include a mix of stocks, bonds, and other assets to smooth out returns over time. Practice dollar cost averaging. Dollar cost averaging, DCA, is a strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This approach minimizes the impact of market volatility and prevents the risk of investing a large sum at an inopportune time. Over the long term, DCA can help lower your average cost per share. Focus on the long term. Investing is a marathon, not a sprint. Markets will experience ups and downs, and short-term volatility is inevitable. However, historical trends show that long-term investments generally yield positive returns. Maintaining a long-term perspective can help you avoid impulsive decisions driven by market fluctuations. How to get started. A step-by-step approach. Once you have a clear strategy, it's time to take actionable steps. Here's a practical guide to help you begin your investment journey. 1. Establish an emergency fund. Before investing, ensure you have a financial safety net. An emergency fund covering 3 to 6 months of living expenses can provide a cushion during unexpected events, preventing you from needing to liquidate investments prematurely. 2. Choose the right investment account. Selecting the appropriate account is crucial. Brokerage accounts. These taxable accounts offer flexibility and a wide range of investment options. Retirement accounts. Options such as 401ks or IRAs provide tax advantages designed for long-term savings. Consider your investment goals and consult with a financial advisor if necessary to choose the right account type. 3. Start with low-cost broad market funds. For beginners, low-cost index funds or ETFs are an ideal starting point. These funds track major market indices, offering instant diversification with minimal fees. They help you mimic the overall market performance without needing to pick individual stocks. 4. Consider a robo-advisor. If managing your investments feels daunting, a robo-advisor might be a good solution. Robo-advisors use algorithms to create and manage a diversified portfolio based on your risk tolerance and investment goals. They offer automated rebalancing and lower fees, making them an attractive option for beginners. 5. Commit to continuous learning and monitoring. Investing is not a set-it-and-forget-it activity. Regularly review your portfolio, stay updated with market trends, and adjust your strategy as your financial situation evolves. Continuous education through books, reputable online resources, or financial seminars can also help you make informed decisions. Avoiding common investment pitfalls. Even with a sound strategy, it's easy to fall into common traps. Here are several pitfalls to be aware of. Reacting to market volatility. Emotional decision-making can be detrimental. When markets dip, it's natural to feel anxious, but reacting impulsively can lock in losses. Maintain your long-term perspective and stick to your strategy rather than trying to catch the market. Attempting to time the market, even experienced investors find it challenging to predict market movements. Instead of trying to time the market, use strategies like dollar cost averaging to mitigate the risks associated with timing errors. Ignoring fees and expenses. High fees can slowly erode your investment gains. Always be mindful of the expense ratios associated with mutual funds and ETFs, and seek low-cost alternatives wherever possible. Over time, lower fees can translate into significantly higher net returns. Lack of diversification. Concentrating your investments in a single asset class or sector can expose you to unnecessary risk. Ensure your portfolio is diversified across different asset classes, industries, and geographies to reduce overall risk. Following unverified investment advice. In today's digital age, investment tips are ubiquitous. However, it's essential to rely on research and verified information rather than hot tips from unverified sources. Stick to your well-thought-out strategy and seek advice from trusted financial professionals when needed. The psychological side of investing. Investing isn't just about numbers and charts. It's also a test of discipline and emotional control. Behavioral finance highlights that many investment mistakes stem from psychological biases and emotional reactions. Maintaining discipline. Creating a written investment plan can help you stay focused during volatile periods. By outlining your goals, risk tolerance, and strategy, you create a roadmap that can keep you from making impulsive decisions. Avoiding over-monitoring. It's tempting to check your investments daily, especially during market turbulence, but over-monitoring can lead to unnecessary stress and hasty decisions. Instead, review your portfolio on a regular scheduled basis, such as quarterly or semi-annually. Educating yourself. The more you understand about investing, the less susceptible you become to market hype and unfounded advice. Invest time in learning about market trends, financial instruments, and economic indicators. Knowledge is a powerful tool that can help you navigate the complexities of investing. Embracing a long-term perspective. Remember that short-term fluctuations are part of the journey. By focusing on long-term growth, you can better ride out the inevitable ups and downs of the market. Patience and consistency are key virtues for any successful investor. Putting it all together, your roadmap to success. Investing for beginners can feel overwhelming, but breaking down the process into manageable steps makes it far more approachable. Here's a quick recap of the steps to take. Establish your financial goals. Define what you're investing for and set clear, measurable objectives. Assess your risk tolerance. Understand how much risk you're willing to accept and choose investments accordingly. Build an emergency fund. Ensure you have a safety net before committing funds to investments. Select the right investment account. Choose between a brokerage account, retirement account, or both based on your goals. Start with diversified low-cost funds. Invest in index funds or ETFs to get broad market exposure. Consider robo-advisors. Leverage technology if you need help managing your portfolio. Regularly review and rebalance. Stay engaged with your investments, adjusting as your financial situation evolves. Continue learning. Commit to ongoing education to refine your investment strategy over time. By following these steps, you lay a strong foundation for a successful investment journey. Remember, building wealth through investing is not about quick fixes. It's about making smart, informed decisions consistently over time. Final thoughts. Investing is a journey that starts with small, deliberate steps and evolves with your financial knowledge and life circumstances. While the world of investing might seem intimidating at first, understanding the basics and building a diversified portfolio can set you on the path to financial independence. The key is to remain patient, disciplined, and continually informed. As you embark on this journey, keep in mind that every seasoned investor was once a beginner. Embrace the learning process and allow your strategy to evolve as you gain more experience and insights. In the end, your commitment to making smart money moves will not only secure your financial future, but also empower you to achieve your dreams. Your path to building wealth starts today. With every decision, every diversified investment, and every reinvested dividend, you are taking control of your financial destiny. Let Smart Money Moves, a beginner's guide to investing and building wealth, be your roadmap as you take confident steps towards a prosperous future. Invest wisely, remain patient, and watch as the power of compound interest and strategic planning transforms your financial landscape. The journey of 1,000 miles begins with a single, smart money move. Make that move today. Whether you're dipping your toes into the stock market for the first time or setting up a diversified portfolio, this guide is designed to be a practical companion on your journey. Remember, investing is not about perfection. It's about persistence, continuous learning, and adapting to new opportunities. Your future wealth is built on the foundation of the choices you make today. Happy investing!